The Federal Reserve, usually just called the Fed, isn't just one bank in D.C. with tons of gold stashed in the basement. It's a whole system of banks and board members set up back in 1913, spread across the country with the mission of keeping America's financial system growing, not too fast, not too slow. Here's the general structure courtesy of the Fed website. The U.S. is broken down into 12 separate regions, each with its own Federal Reserve Bank. These 12 regional institutions kind of serve as the bank for the banks that we all use. They each have their own presidents and leadership that hold cash reserves of federal banks. They move coin in and out of circulation, give banks loans, and supervise the soundness of consumer institutions. Back in D.C., the powerful Board of Governors oversees the dozen federal outfits that dot the country. This board, in theory, has 7 members, nominated by the president and confirmed by the Senate. They each serve a 14-year term. Right now, though, 3 of the seats are empty. Here's where the power gets centralized. 2 of the board members have higher ranks. They're the chair and vice chair. The president chooses from the pool of board members, and the chair and vice chair are given their titles for 4 years after the Senate approves. The chair is highly influential in setting monetary policy. Monetary policy, what is that? Basically, how much it costs to borrow money. This takes us to the last key element of the Fed. All 7 board members in D.C., plus 5 of the regional bank presidents, function as the Federal Open Market Committee. Together, they decide if the national interest rate goes up or down. A quick economics review here. If interest is low, more businesses and people borrow money. The money floods that marketplace, increases the demand for services and products. And since demand is outstripping the supply, wages and prices go up. So what cost $100 last year could be $104 this year. This is called inflation. The Fed sets monetary policy to keep inflation low and the dollar strong. To do that, they raise the interest rate, making it more expensive to borrow money. When it's time to grow fast again, the rate goes down.